Tonight we examine what would it take to actually break the silver market. March looked scary for a while until it settled cleanly. So let's stop fantasizing. If we're waiting for the silver market to implode because a few volt chart looks scary, we're probably all going to be waiting a very long time because COMEX is not fragile, it's engineered. And so the real question isn't, will May deliveries drain the vaults? The real question is, what structural event would overwhelm the system's pressure valves? Because unless those fail simultaneously, COMEX wins again. So it would take a sustained physical disconnect. One day of backwardation, noise. One heavy delivery month, more noise. You would need persistent multi-month backwardation where near-term contracts trade above deferred months and stay there. Conceptually, you'd be seeing something like this. Y equals 30 minus 0.05x. And I could give you a long string of numbers, but basically it's a downward sloping curve representing future prices lower than spot, sustained over time. And that tells you immediate metal is scarce, the market is unwilling to wait, time no longer cures the imbalance, temporary backwardation is stress, and persistent backwardation has become structural, which brings us to point number 2. Delivery demand would have to spike and stay elevated. Normally, most open interest rolls. We saw that in March. By all means, it shouldn't have, but it did. And for the system to break, a large percent must stand for delivery. That behavior must repeat across multiple months. Commercial shorts must struggle to source metal. The math here isn't complicated. It's a multiplicative probability. You'd need high standing rates, low inventory replenishment, and no eligible conversion all at once. Historically, those probabilities compound downward fast, which brings us to point number 3. Eligible metal would have to refuse to convert. This is the part most people miss. COMEX reports registered, which is deliverable now, eligible, which meets specs but isn't pledged, and if spreads widen enough, eligible metal usually converts. For failure, you'd need owners unwilling to pledge metal at any price, a trust breakdown, fear of counterparty exposure, and that's not a supply issue, it's a confidence crisis, and those tend to be rare. London would also have to decouple. The silver market is global, and if the London Bullion Market Association, or the LBMA, London for short, market, continues functioning, arbitrage connects prices. If COMEX silver spikes relative to London, traders just ship bars. For a real bank, you would need EFP spreads blowing out, London liquidity drying up, cross-market arbitrage failing, and that's systemic, not seasonal, which brings us to point number 5. Industrial users would have to panic buy. Silver, as everybody knows, is not just monetary. It's industrial, it's solar, it's electronics, and, most recently, it's defense. If large manufacturers decide inventory security is greater than price sensitivity, you get forced bidding. That creates a positive feedback loop. Rising prices yield fear of shortage, which yields more buying, which yields, of course, rising prices. Visually, that's exponential stress. So it's not a squeeze, it's a reflexive supply shock. We have not seen that behavior recently. It doesn't mean it couldn't happen, and it doesn't mean conditions aren't right, but that's what would have to happen. Which brings us to point number 6. The clearinghouse would need to lose credibility. The final domino isn't metal, it's trust. COMEX survives because participants believe contracts will clear, margin rules will adjust, we've seen a bunch of that, and settlement will occur. If confidence in the clearing mechanism breaks, then participants demand physical, not because they need it, but because they distrust the system. That's how markets actually fail, not through arithmetic, through psychology. So what's more likely, a dramatic vaults empty headline or a slow grind of volatility, margin hikes, and roll pressure? History says more grind, more adaptation, more structural resilience. The exchange doesn't need infinite silver. It needs enough silver to clear the fraction that actually stands. And historically, that fraction is small. And so the honest take, could silver experience a violent repricing? Yes. Could delivery stress spike volatility? Of course. Could premiums detach from future price? Yes. But an outright exchange failure? Remember, that requires persistent backwardation, multi-month elevated standing, eligible refusal, London dislocation, industrial panic, clearing distrust all at once. And it's not impossible. It's just statistically rare. And until those signals align, the more probable headline is boring. Margin rise, spreads widen, metal moves, contracts clear, COMEX wins again. Thank you for watching all the way to the end. As always, take care of yourselves and each other and build that stack.